As you can see from the journal entries in these examples, the balance in the various accounts accumulate from month to month. Often our favorable and unfavorable variances will balance out during the year, leaving us only a small amount at the end of each year. In that case, then we close all of our variance accounts into cost of goods sold. However, if we have material dollar amounts in our accounts, variance accounts at the end of the year, then we should apportion those among work in process inventory, finished goods inventory, and cost of goods sold accounts. Remember, what constitutes a material dollar amount varies from company to company. Now we're going to talk about those cost variances that we experienced in this example from the perspective of various managers. So we have a cost variance summary report, and we have the managers together for a monthly staff meeting. And we're going to look at how they defend what their variances are, discuss about why their variances happened. So we're going to recap what those variances were that we talked about. So we had all told a materials variance that was favorable, total labor variance that was unfavorable, and a total overhead variance that was unfavorable. All together, we had a total manufacturing variance that was $80 variable. So first we start with the accounting perspective. So the accounting perspective is that we have good news, bad news. So good news, the company's total manufacturing cost variances was favorable for the first time in months. Even though it was only $80, it was still a total variance. We're pleased with this effort to control manufacturing overhead costs associated with this product, as revealed by a $520 favorable overhead spending variance. However, the bad news is that there were several unfavorable variances experienced in the beams product line. So we're troubled about the labor efficiency and the labor rate and the materials quantity variances. And we want to know why some of those negative variances happened. Well, first, the purchasing manager talks. So he got such a good deal for these beams. He saved the company $9,000 by shopping around for the best price. And because he had gotten such a good price, it was such a great cost savings. And so he had really good results. And we shouldn't be talking about these unfavorable results because we should really be awarding him for saving us $9,000. However, the production manager isn't very impressed with this. He says that the materials that were purchased at such a discounted rate were very inferior quality. And because of their inferior quality, he had to have overhead time, he had production bottlenecks, poor quality materials had caused production output to be significantly less than normal, that the main reason that they hadn't made 700 beams was because they couldn't, because they were taking so much extra time getting the cheap beams they had purchased up to a production usage. And they could have had a lot more scrap. So if you saw, we budgeted to use 158,000 board feet. We actually used 180,000 board feet. That indicates that there was quite a lot of scrap in that material that wasn't even usable, that we just threw away. And that's one of the reasons that we went through so much more material. The quality control inspector agrees with the production manager's assessment. So they said most of their beams failed to pass inspection And the ones that did pass inspection only did so barely. So she's never had a month where she's rejected so many of their produced beams for quality issues. The factory workers are also upset. So they had really low morale because of all of the extra work that they were doing. Their productivity was way down and they had overhead expenses. And everyone on the production crew was grumbling because all of their problems were caused by the lower quality materials. He said the only thing good about the inferior materials is that they get all of this overtime pay from working extra hours. So our unfavorable labor rate variance was mostly from overtime pay rates. The marketing manager said that even with overtime and extra shifts, demand still exceeded output. So the unfavorable volume variance had severe implications. They only made 600 beams, but their demand was much higher than 600 beams. Not only that, but the beams weren't their normal quality. So that he's both concerned that one, if they can't make their customers happy, are their customers going to leave? So consistently not being able to fill orders because you can't produce enough to fill your orders means eventually customers are going to start going somewhere else where they can get what they're ordering. Then giving customers a lower quality item than what they expect is also going to make your customers upset. Then we also have, will there be legal liabilities? Are any of these beams going to be structurally unsound because of the number of defects that were found in them during production? So you can see now from all of these examples that different people are affected differently. Different people within the corporation are affected differently by these different variances. So what worked really well for the purchasing manager actually had negative impacts on the production manager. And if those negative impacts from poor quality go all of the way through to the customer, it could have significant impacts on the company as a whole. So while overall in the perspective, they had a manufacturing variable that was favorable for $80 for the entire month, those negative or unfavorable balances could have more significant impacts to the company as a whole. So then looking at just-in-time systems and variance analysis. So just-in-time approaches combined with total quality management approaches in manufacturing can reduce or eliminate many unfavorable cost variances because both of these manufacturing philosophies of just-in-time and total quality management require that our materials usage variances caused by defective materials is completely minimized and or eliminated. And workers in a just-in-time system are already trained to be able to shift production quickly depending on a customer's order, because just-in-time doesn't even start production until a customer order is received. Their workers are trained to be as efficient as possible. So there are very few labor variances there. Really well implemented just-in-time approaches and total quality management approaches are doing everything they can to eliminate unfavorable variances. So they don't always have the same issues as a standard manufacturing environment. Then last, we have the ethics, fraud, and corporate governance. So our standard costing systems, because that is how we use for our inventory and cost of goods sold figures, we have to report as reliable standard costs as we possibly can. So if our standard costs are not representative of our actual costs, then our financial statements are materially misstated because that is how we're recording our cost of inventory. So if we have really high variances that are more of a result of poor standards than they are of poor efficiency, we need to reevaluate what standards we are using for our costing system, because we could run into ethical issues if we're not using good standard costs. And that is the end of chapter 24.